Okay, let's talk about a question that sounds super simple, but the real answer, well, it could change how you see our entire economy. And that question, where does money actually come from? You probably think you know the answer, but the reality is one of the best-kept secrets in finance.
See, most of us learned a story back in school about how banks work, how money gets made. But what if that story, the one still being taught in economics classes today, is just a myth? And what is the way it really works has built a system that's way more unstable and unequal than any of us realize.
The story we're all told is called the money multiplier. It's this nice, clean little model that explains how banks take our deposits and then lend them out, creating more money along the way. It sounds pretty logical, right? So let's quickly walk through it.
Okay, so the textbook version goes something like this. It all starts when you, let's say, deposit $100 into your bank. Now, the bank is required to keep a fraction of that on hand, we'll say 10%. It then lends out the other $90. The person who borrows that money spends it, and whoever they paid then deposits that $90 into a second bank. And that bank, it does the exact same thing, keeps 10% and lends out the rest. And this cycle is supposed to repeat over and over again.
And this process just keeps on going, with that same initial deposit getting loaned out again and again. So, with a 20% reserve requirement, that first $100 deposit could theoretically grow into $500 in the economy. This is what they call the money multiplier effect, and it's a core idea in how we're taught to think about banking.
Now, what's really fascinating about this model is that it has a huge, critical vulnerability built right into it. Because banks only hold a tiny fraction of our deposits, the whole system is actually incredibly fragile.
And that vulnerability has a name. A bank run. If enough people get spooked and try to pull their money out all at once, the bank just doesn't have it. It can't possibly meet all the withdrawal requests, and that fear becomes a self-fulfilling prophecy. The bank collapses.
And believe me, this isn't just some textbook theory. Bank panics have been at the absolute heart of America's worst financial crises. You had the Panic of 1907, which actually led to the creation of the Federal Reserve. Then, a wave of bank failures made the Great Depression so much worse. And of course, the ghost of that instability came right back to haunt us in 2008. It is a recurring, absolutely fatal flaw in the system.
The consequences, for the rest of us, they're devastating. Studies of crises going back to the 70s show that a major banking crisis wipes out, on average, a staggering 20% of a country's entire economic output. We're talking lost jobs, businesses failing, and years of hardship for regular people.
So, the model we're all taught describes a system that is naturally fragile and just prone to crisis. But here's the big twist. What if that's not even how it works? What if money isn't multiplied from our deposits at all, but is created in a totally different way?
Now, don't just take my word for it. Here's a quote straight from a 2014 report by the Bank of England, the UK's central bank. They say, pretty bluntly, that the money multiplier theory taught in textbooks, well, it's just not an accurate description of how money is created in the real world.
So here's the real difference, and it is a big one. The textbook myth is a reserves-first model. Banks have to wait for your deposits before they can lend, but the reality is a loans-first model. Banks don't lend out money that's already there. When a bank approves a loan, they just type the numbers into your account, creating a brand new deposit out of thin air. The loan creates the money. Finding the reserves to back it up is something they worry about later.
And this is not a new discovery. Professor Charles Goodhart, who was a top advisor at the Bank of England for decades, said this way back in 1984. He called the textbook model misinstruction. So the people at the top have known the truth for a long time, even while the rest of us keep learning the myth. Okay, so if private banks are creating new money every single time they make a loan, that brings up a really important question. Where is all this new money actually going?
You know, we tend to think that banks are out there funding new businesses and entrepreneurs. But when you look at the data, you see a completely different picture. In the UK, for instance, only about 15% of bank lending actually goes into business investment. A whopping 75% goes toward mortgages and loans against existing real estate. So banks aren't really funding new, productive things. They're mostly just financing the buying and selling of assets that are already there.
So the crucial point here is that this creates a really dangerous feedback loop. Banks create new money to lend for property. All that extra money chasing the same number of houses inflates property prices. And those higher property prices, well, they just serve as collateral for even bigger loans.
It's a cycle that just feeds on itself.
And as Lord Adair Turner, who used to be the top financial regulator in the UK, puts it pretty bluntly, these credit-fueled real estate cycles, they're almost the whole story behind financial instability. The boom always, inevitably, leads to a bust, causing a recession and hurting the exact people who got caught up in it.
And look, this isn't just some abstract problem for economists to debate. This system of money creation has direct, very real consequences for every single one of us.
This is really where it hits home. That boom-bust cycle creates constant job insecurity. The relentless climb in house prices, fueled by all this bank credit, pushes home ownership further and further out of reach for millions. And as asset prices go up, people who already own property get richer, while everyone else gets left behind. It massively widens the wealth gap. And the whole system relies on all of us taking on more and more debt just to keep the wheels turning.
So when you see that the system is basically designed to produce these damaging results, it's really no surprise that economists have been looking for a different way for almost 100 years. In fact, all the way back during the Great Depression, some of America's leading economists came up with a radical solution. It was called the Chicago Plan, and its goal was to take the power to create money away from private banks.
And this wasn't some fringe idea. A working paper from the International Monetary Fund looked at the plan again in 2012 and found the potential benefits could be enormous. It would give us way more control over the boom-bust cycle, it would completely get rid of bank runs, and it would lead to a massive reduction in both private and public debt.
Which brings us to the fundamental conclusion from all this. We now know that private banks, not the government, create almost all the money in our economy. And we know they create it mostly to pump up asset bubbles that lead to financial crises and make inequality worse.
So the final question we're left with is a big one. Should they have that power at all? It's a question that really challenges the foundation of our modern economy, and it's definitely one we're thinking about.